My name's Simon Barnard. I'm Portfolio Manager of the Smithson Investment Trust. And I know that there is a mix of first-time investors on the webinar and seasoned operators. So I'm going to try and cater to everyone. But of course, if I do miss anything or you would like to know more about anything, do please not hesitate to ask a question. So this presentation is going to be a little bit different to what you're expecting, perhaps. In terms of looking for global opportunities, as a portfolio manager, I don't really focus on very near-term themes or try to predict near-term events. It's simply impossible. And also, it's not really the style that we take. We're very long-term investors looking at companies that we can own over many years. And so jumping in and out of different themes isn't really the sort of thing that we do, and I would argue is actually quite a difficult thing to do in the first place. Instead, what I want to do is arm you with several key investing concepts that if you take these to heart and use them in your own investing endeavors, then it will actually help you to generate more returns from what you're doing and hopefully make fewer mistakes. So let's kick off then. There are several concepts that I really want to introduce because ultimately it's these key concepts that are going to do the heavy lifting for you. So, you know, there's a great quote by Carver III, the UK philosopher, who said it's better to be vaguely right than precisely wrong. So if we can get along the right track with these concepts, then I think, you know, you'll be most of the way there. So the first concept is make investing as easy as possible. Investing's hard. I mean, it has to be hard. So many people are trying to do it, and if it was easy, everyone would be a millionaire, and they're not. So what we've got to do from the very off is try to make investing as easy as possible. Now, the first way to do that is to just focus on investments that tend to do well over time. I mean, it sounds obvious, but a lot of people don't do that. I think they're looking for the next big thing. They're looking for the next lottery ticket that's going to make them hundreds of % return in one idea. Well, while it does happen, it's very rare, and it's even rarer for you to go out looking for it and find it before it takes off. More likely is that you're going to buy a whole load of these potential lottery tickets and they will turn out to be duds, and you've wasted all of that time when you could have been steadily compounding your capital. So what we do at Smithson Investment Trust, and I would recommend you read our disclaimer in your own time, is that we focus on small and mid-cap companies. And the reason is they tend to do better over time than large cap companies. What I've shown here is a chart over the last 20 years, and that's quite an arbitrary period, but we do take, you know, we've taken lots of different periods, and it tends to be the case that small cap outperforms large cap. Here, you can see that if you'd invested in the MSCI World Small and Mid Cap Index, which happens to be our reference index, you would have made around 586% over the last 20 years. But if you'd invested in the MSCI World Large Cap, that would have returned 385%, or about 30% less. So again, they don't outperform in every period, but generally over time, they do tend to outperform. And why is that? Well, it's quite simple. Smaller companies tend to grow faster than large companies. And that's really down to the law of large numbers. When you've got a very big company, to recreate that same growth rate year in, year out, obviously it has to come up with a bigger and bigger and bigger amount of revenue and profits to do so. Whereas small companies, they do have to keep coming up with more and more revenue, but it's on a much smaller base, and it's much easier to do if they're the right company. So to demonstrate this, we can look at this very simple chart. And what I'm really trying to show you here is that if you start with a large cap company of, say, $500 billion in market cap, and you grow that at 20% per year over the next 25 years, it would end up becoming larger than the whole of the US economy, which has been growing at 2%. Now, it's technically possible, but it's never happened, and it's very unlikely to ever happen. Whereas there are many, many small cap companies, in fact, we own some, that have compounded at over 20% for over 20 years. And that is really where you can make a lot of money. So what really is the best thing to do about this? I mean, despite focusing on small and mid cap, what we try to do is then restrict our universe even further. So we rule out many sectors that we have determined over the very long term tend not to generate returns for shareholders. So that includes everything from auto manufacturers to real estate companies to utilities to commodity industries. Basically, anything that has very cyclical demand, a very commoditized product, or requires a lot of debt to make reasonable returns. Ultimately, you should try to be owning companies that don't have a lot of debt. And this really, when we think about what that leaves us with, we're left with companies in spaces like technology, healthcare, consumer, all of which can have very differentiated products, higher growth areas, and therefore more sustainable chance of generating returns over time. And the second concept you really need to think about when taking all of this in is the idea of price versus value, i.e. what you are paying for a company versus what you're getting for that company. The way I always describe it is, imagine a dog walker walking across a field. Now, the value of a good company will continue to make steady progress, walking across that field, clear in direction, whereas the market price, the stock price of that company is like the dog, wildly zigzagging around the walker as they walk across the field. Now, clearly, we want to focus on the value of the company. We want to focus on good companies that continue to build that value over time in a steady manner. We're not so focused on the dog that's wildly zigzagging around, and that's, as I was referring to much earlier in the presentation, those are the near-term effects, the near-term events, which are almost impossible to predict where that dog is going to run next. But the reason we focus on the value is eventually the walker and the dog will meet, just like the value and the price will meet. And it's then that you will have that value realized in the stock market valuation. And this really leads on to the strategy that we employ, which is number one, we buy good companies. Number two, we try not to overpay for those companies. And number three, we then do nothing. That's a very simple method, but it is it's placed us in good stead. And Fundsmith has, as Dan says, is the overarching umbrella company. They have performed extremely well for the last 10 years. Smithson in the small and mid-cap space has also done well since its inception. And we believe that this is a very strong long-term methodology. So what do we mean by good companies? Well, we mean companies that have a high return on invested capital. And that just means that its earnings is high relative to, and we can approximate invested capital with the sum of the shareholders' equity and the debt of the company. That is a very rough approximation, but it's easy to do. If you wanted to know more, of course, I would highly recommend you reading a couple of accounting books. This stuff really isn't very difficult and only requires very simple mathematics. So if you are interested in this, I really recommend you read more about it, but you can do it very simply as I have just suggested. But these good companies also need to generate a lot of their earnings in cash. Now that sounds like a funny thing to say, because don't all companies generate cash? Well, no, even companies that say they've got good earnings on paper quite often don't actually generate that much cash at the end of the day, because they are either having to invest so much in the business because they are capital intensive, or ultimately they simply have too much capital invested in inventories or other working capital. That means that they can't free up cash over time. So we're looking at companies that do generate a lot of cash. And finally, of course, we want companies that grow by a good amount, so more than 5%, preferably more than 10% a year, but importantly, sustainably over a long time. So the first bit, find good companies. Now, this might be more interesting. These are a few of the companies that we ourselves research and have looked at. Now, each one in turn has a theme that I put forward, not a short-term theme, but a very long-term theme that we believe will generate good growth over many years to come. I'll very quickly run over these companies, but of course, if you want to know more, please do ask questions at the end. So Temenos is a software company that provides software for banks. So they allow banks to become more digital in their offering. So either offering accounts or loans online or through your mobile device. And they are particularly popular with what we call neobanks. So these banks that are starting up, like Starling, for example, that have no traditional branches and are only operating online. And I don't know that if Starling is, but many of these would use Temenos software to do that. The second company is a US company. This is another software company which focuses on human resources software for small companies. And here I'll put market share gains ultimately because it has a very small market share in the US, its home market, of around 5%, but is growing very quickly because its software saves companies so much money, bearing in mind that it takes out a lot of the requirement for human HR managers because employees can interact directly with the company database. The next one everyone will have heard of, I presume, Domino's Pizza. This is a great franchising business. Now, franchising is fantastic because the parent company can grow without deploying any capital of its own. So in a franchising business, it's the franchisees that are deploying their own money to build stores, open restaurants, and they just pay a royalty to head office. And in the case of Domino's, they actually buy all the food from the head office. So actually, what many people don't realize is Domino's Pizza Group, the company, are actually predominantly a food provider to franchisees. That's where they make a lot of money, by selling dough, pizza boxes, uniforms to their franchisees who have to pay that to them and can't get it anywhere else. Automation is another long-term theme, and Cognex is a US company that produces vision systems. So they have sort of scanners and artificial intelligence that helps them scan items as they pass at rapid speed to either read barcodes or more complex items, the size and shape of things. So this would be used in automated factories, or of course, more likely nowadays, automated logistics warehouses. So Amazon, for example, would use these type of products in their warehouses to sort parcels. Again, another well-known UK consumer brand, Fevertree, and the premiumization. Again, we are seeing strong growth in Fevertree, not actually in the UK anymore. That's a very mature market for them, where they dominate the market, but in their newer markets like the US, where they're growing 30 to 40%, or in Europe, where they're growing about 15%, or even in Asia, where they're growing more than that. But this theme of premiumization, where people are choosing to buy fewer items but higher quality items, and we're seeing that not only in the tonics business but also in the spirits business. People are choosing to buy higher quality premium spirits rather than cheaper vodkas and so on. The next one is around regulation. As we all read in the paper every day, we are seeing more and more regulation, not only in financial markets, but in this case, in construction markets. Nemetschek Group is a software provider to construction companies. So they provide design packages, which of course embed all the local regulations throughout all the markets that they operate in. And more, increasingly, the regulators in these construction industries are requiring the type of software that Nemetschek provides, which to my surprise isn't the case in all markets, but more and more this type of design and safety software is being stipulated by the regulator, and that will only continue. Another source of perpetual growth is market consolidation, and Rollins is a pest control company, so quite different to everything we've been discussing. They literally have people in vans driving around to people's houses, spraying them for bugs and insects. Now, that's not particularly well known in the UK, but this is happens to be a US company, and in places with much warmer climates, it becomes an absolute necessity to have your house with a pest control company who comes and visits every month. Otherwise, it would literally become uninhabitable uninhabitable. So this is a subscription business in most parts of the world where people pay monthly for their pest control. But in Wallin's case, obviously, pest control is not an exciting growth business. The underlying business grows about 3 to 5%. But what they do is they buy up lots of very small pest control businesses throughout the US and now other countries and bolt them into their network, which means that over time, their actual revenue growth is more like 9 or 10%, despite the underlying business growing much more slowly. Innovation is clearly another theme that you look for in long-term growth, and Ambu is a key player in that in our minds. Ambu is a medical device company based in Denmark, and they produce disposable endoscopes. Now, endoscopes, of course, are what doctors use to look inside patients, and most endoscopes are reusable. In fact, they're used on about 200 patients before they're changed. Now, they are cleaned in between every procedure, but unfortunately not perfectly. So there is a rising incidence of infection rates from reused endoscopes. And this obviously has become particularly pertinent in the COVID pandemic, where endoscopes were used, pulmonary endoscopes particularly were used to help COVID patients. But of course, given how infectious it was, many subsequent patients being used with that endoscope were catching COVID. Not only that, but the people cleaning the endoscope were catching COVID from the same device. So Ambu, on the other hand, produces endoscopes which are completely disposable. So each time you use a fresh one, use it only once, and then send it for recycling, and it is never used again. So that completely cuts to zero all of these chances of infection. This is a company, as you might imagine, that is growing very quickly. And then finally, vanity. I mean, human vanity is always one of the best bets you can make. And this plays out through cosmetics, through luxury goods, many, many ways. In our case, we look at a company called Moncler, which is a smaller luxury goods company. Many might know the puffer jackets that they're quite famous for, but of course they do sell in many other categories as well. But this, again, is a theme that never seems to get old. So ultimately, these are all companies, as you can tell, that have what we call intangible assets. So these are not assets that depend on large factories or large swathes of real estate. They all depend on patents or brand names, things that they have taken many, many years to develop with a lot of spending. And that is what makes them so hard to compete against, which is why we believe that over time, their products and services will be very defensible against competition. And that is why we believe that they will remain good companies over the long term. Because obviously, if you want to buy and hold something, there's no point holding something that's not going to continue being good. You want to find those companies that continue to be good for a long time, so you can sit and hold it and wait for it to compound in value. So that is where I want to really introduce the final concept, and that is time. Now, ultimately, your returns will be generated by holding the right asset, the right investment for a long period of time. And funnily enough, it doesn't really matter as much how much you pay for that. Now, there is, of course, a limit. So you don't want to overpay for a company, because when you start paying the wrong price, the best company in the world would become a bad investment, because you're paying more than it's worth, even taking into account the long-term growth ahead of it. But funnily enough, it is quite hard to overpay for a very good company. So, for example, they're not, these good companies are quite rare and difficult to find. But if you hold on to them, you can make a lot of money, even if you pay what sounds like a high price. So, one example we often give is, if you had bought L'Oreal 40 years ago on a price to earnings multiple of 280 times, you would still have generated a return better than the general stock market. And that's because the company had done so well over such a long time. And this slide tries to illustrate that. So if you chose company A with a net income of £1,000, a return on capital employed of 20%, Now that means that if it keeps reinvesting everything that it earns at that 20%, that over the long term, roughly, its growth will equate to 20%. But let's say with this company, you pay 40 times price earnings at the start of your investment and you sell it at 20 times. So in effect, the valuation is halved over the time that you own it. Or you choose company B, which has half as much return on invested capital, only 10%. But this one, you get a lot more lucky. You buy it at 20 times price to earnings and you sell it at double that valuation at 40 times. You know, what's going to outperform? Well, the clue, of course, is in the quote from our friend Warren Buffett, who is one of the most famous investors in the world. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And you can see the results here. Company A, over the course of the 40 years, generates so much more returns, even though its valuation is halved, compared to a company growing half as much, but doubling in valuation over the same time. And this is the point about time, because ultimately you want to be owning these things for a long time once you've found the right company. And the reason for that is these investments tend to go up over time. So once you've found these companies, the best thing to do is to do nothing. And when we look at this chart, which is the US S&P 500 index over the last 100 years, if you just sat on your investments, you can see that you would have done well almost whenever you bought it. So the Great Depression of the 1930s is almost invisible. You know, the Black Monday 1987 is just a tiny blip. Even the dot-com crash and the Great Recession of 2007, they're a lot more meaningful, sure, but we've left them long behind. And right up here, you can just see the start of the 2020, well, here it is, the 2020 pandemic and the effect that that had on the stock market. Ultimately, it's a very interesting fact that if you were to own this index, even though it went up by this much over time, if you just owned it for one day, your chance of making money is around 50-50. So in any given day, it could go up or down about 50-50. However, if you owned it for 15 years, so you've changed nothing except the time you hold it, so exactly the same asset. But if you hold it for 15 years, because it tends to go up over time, you've got almost 100% probability of making money. And that's because there is no 15-year time period since the Great Depression of the 30s where the index was not higher at the end than at the start. Even if we include the Great Depression down here in the 1930s, then still 97% of the time, if you bought the S&P 500 and held it for 15 years, you would make money. So I'm not saying, therefore, that you need to own it for 100 years, but if you can own these equities for 10 to 15 years, you are extremely likely to make money. And what is the flip side of that? If you try and jump in and out of the stock market, it's very likely that you're going to damage your returns. You know, this is the hardest thing to do, to find these great companies or indexes and sit on them for a long time. And in fact, you know, this is where we quote Sir Edmund Hillary: it is not the mountain that we conquer, but ourselves. It is very difficult to just sit there, even when your investments look like they're doing very poorly. You've just got to sit there and hold it out. The reason for this is this next slide, where if you had invested £10,000 into that index that we just looked at for 15 years, then ultimately you could have made an annualized 10.6% return, which gave you £45,000. But if you try to jump in and out and you missed just the 10 best trading days, the days with the highest single day move, then actually your returns would halve to 5% a year or £21,000. That's just 10 days that you miss. And actually, if you miss the 30 best days, your returns would be negative, even though the index overall went up over that time. So the message from this is really, you've got to be in the whole time, because the stock market does not go up in a linear fashion. We know that it's volatile. And so you don't want to be out of the market by accident when you have a big update, and you'll never know when it's going to come. Of course, that's true of the down days as well, but we know that overall they balance out to become positive over time. So you just don't want to miss those big up days, which you can do if you're trying to jump in and out of the market. And so finally, what we do at Smithson is, like you may have gathered, we try and find these good companies, we try not to overpay for them, and then we do nothing. In fact, our turnover of the portfolio last year was less than 10%. So that means that on average, we hold our companies for at least 10 years. Now, this is an interesting graph which shows that over time, the holding period of people in the stock market has grown less and less. So back in the 1940s, on average, people held companies in the stock market for 7 years. But over time, that has become far less than 1 year in the 2010s. So for us to be holding our stocks on average for 10 years is a big deal. It's very different to what the market is doing. And we love this quote here from the late Sir John Templeton: if you want to have a better performance than the crowd, you must do things differently from the crowd. And so just to leave you with our final slide on the performance of the Smithson Investment Trust, you can see that we have actually outperformed our reference index, the MSCI World SPID Index, every year since inception, with the exception of the year to date, where the fund is down much more than the equity benchmark. That is, of course, because we're seeing a lot of other types of company in the index do well, like commodities and so on. These are companies that we would never own, actually. And so we are happy to watch this pass us by and wait again for our time to come. But actually, it's quite an exciting time for us, because it's a period where, although we tend not to take much action, it's a period where we do tend to do more, because we are finding those great companies dropping in value. And actually, even in the short period since the start of the year, we've already added 2 new companies to the portfolio. We only have 32 positions, so it's very concentrated. So to add 2 new companies is a big deal for us. And that's simply because these great companies that we watch all the time have fallen into a price range that we'll feel comfortable. But it does mean that over time, since inception, we have annualized a performance of around 15% versus the index at 10%. So I'll leave it there, but very happy to answer any questions in the upcoming session.